Here are 10 predictions I have for 2026. The S&P 500 will be in a bear market, correcting from $6,900. At a macro level, nearly everything is screaming top signal. Owning the S&P 500 has never been less diversified. The majority of the gains in the S&P 500 are coming from the Magnificent Seven, while the vast majority of the index is actually consolidating or bleeding. The Shiller PE ratio is at near record highs. In other words, it's at one of the most expensive levels in history. The Buffett indicator, which measures the value of the US stock market in terms of the US's GDP, is also saying that it's at the most expensive level in history. Finally, there are multiple Fibonacci retracement levels that are providing parallelized resistance at $6,900. Every other prediction from here is based on this very first prediction, so if I get this one wrong, they're all wrong. Number 2, heavy metals will consolidate to a local low in 2026 and then run for the rest of the decade. I have to give credit to my one and only prophet, Benjamin Cowan. He was basically spot on with every prediction about heavy metals so far, and I have no reason to doubt him now. Heavy metals are currently in a bull market, with gold leading the way. And as most financial assets do, when they make a new all-time high, there's almost always a pullback, allowing investors a final opportunity to enter before the rocket ship takes off. I'm personally heavily invested in the continued success of heavy metals, with my investment, PAL, a palladium ETF. Number 3, Accenture will be a buy at the 200-month moving average in the summer of 2026. Even as an industry leader in consulting, the stock price is currently showing weakness, currently trading below the 100-month moving average. On a technical level, the 200-month moving average is historically an excellent buying opportunity for most industry leaders. Assuming earnings stay the same, a 30% drop in price would also represent a 14 PE ratio, which is just a mouth-watering level for value investors. Fundamentally, I don't expect Accenture to be overthrown in the coming decades, so I'm looking to scoop some at the $160 to $180 level this summer. Number 4, this one's for my train lovers. Canadian National Railway Company will be at a buy at the 200-month moving average. Similar to Accenture, it's currently trading below the 100-month moving average, and a 30% correction will put CNR at both the 200-month moving average and a 14 PE ratio. While I personally dislike the lack of growth that railway companies offer, I think this would be a historical buying level. Number 5, Lululemon will consolidate, then run. I'm especially biased on this one, considering I've already bought my bags in my retirement account. However, Lululemon has already visited the 200-month moving average, which also corresponded to a PE ratio of 12. This is historically low for both the company and the industry. It's currently down on the FUD of slowing growth in the United States, increasing costs due to tariffs, and increased competition with Alo and Vuori. However, I simply cannot ignore the fact that so many other major companies have failed to dethrone Lululemon and its status as a premium athletic apparel company. I'll just say, if it ain't broke, don't fix it. Number 6, United Healthcare will consolidate and run. I'm also heavily biased, as this is by far my biggest bag. I bought a ton of UNH at $250, which corresponded to the 200-month moving average and a PE ratio of 10. I seriously don't see the future of health insurance changing anytime soon. This company is going to be a $1 trillion company at $1,000, assuming that the status quo doesn't change. But I guess, hey, stranger things have happened. Number 7, select meme coins will be buys at generational bottoms. There are some fundamental reasons why meme coins as an asset class interest me so much. Meme coins are not considered securities under the current SEC. Meme coins are therefore under less regulatory scrutiny compared to stocks and bonds. Market manipulation already runs rampant with regulated securities. I don't see why meme coins wouldn't offer a lower friction way of doing the exact same thing. Retail sentiment has also never been lower in crypto due to a lack of an alt season. So, once the unthinkable decimation happens, is exactly when I'll be looking to buy category-leading meme coins. At the end of the day, the promise of 100x or even 1000x is going to be so compelling, it will resurrect an exhausted swath of retail and bring them back into meme coins. Number 8, Nvidia will fall between $65 and $35. I'm not confident enough to actually bet against Nvidia, but I do think the AI bubble will pop spectacularly and retrace 60 to 80%. Don't get me wrong, I think AI will be the future, and Nvidia will remain an industry leader, but I think AI is currently drawing way too many parallels to the dot-com bubble. I think their circular revenue streams seem borderline fraudulent to me, but I'm in no way a legal expert. So, I'm not confident exactly when it will pop, but I am confident that I would be a buyer if it fell to the $35 to $65 range. Number 9, Chipotle will drop to at least the 100-month moving average. This is more of a hope than a prediction, but it's currently bleeding below the 50-month moving average, and for a fast food company, its PE ratio has been unbelievably high for so long. When we finally get a bear market, I fully expect there to be a reset. However, I'm personally not buying unless it reaches the 200-month moving average, whenever that is, whether it be in 2026 or 2027. And number 10, my Robinhood account will reach $100,000.